Assalamualaikum. So in this video lecture, we'll be discussing a supplemental lesson on working capital management. So this is supplemental because ordinarily this topic is under short-term financing. So I just decided to include this in the current liabilities management because it is still a part in the working capital management in managing our current liabilities. Okay, so we have our first, the accounts payable or our trade credit management. So accounts payable or trade credit is actually the largest single category of our short-term debt. So this credit is a spontaneous source of financing. So when we discussed the lesson 1 in working capital, we mentioned there about spontaneous source. Okay, spontaneous source of financing. So accounts payable or trade credit is a spontaneous source of financing in the sense that it arises spontaneously from ordinary business transactions. So spontaneously, it is being generated. So for example, now if a firm makes a purchase of 1,000 on terms of net 30, it must pay for goods for 30 days after the invoice date. So this instantly and spontaneously provides 1,000 of credit for 30 days. So if the firm purchases 1,000 of goods each day on average, it will be receiving 30 times 1,000 or 30,000 of credit from its suppliers. So if sales and consequently purchases will double, so this accounts payable account will also double to 60,000. So meaning to say, simply by growing, the firm spontaneously generates another 30,000 of financing. So similarly, if our terms would be extended from 30 to 40 days, our accounts payable will expand also from 30,000 to 40,000. So therefore, when we expand sales and we lengthen our credit period, this will generate additional financing. So trade credit may be free or it may be costly. Okay, so if the seller does not offer a discount, the credit is free in the sense that there is no cost for using the credit. But if discounts are given by the supplier, a complication will arise. No? So, for example, suppose a company will have will buy 20 chips each day with list price of 100 on terms 2/10 and 30. So we know that the terms 2, 10, and 30 meaning there's a discount period of 10 days and you get 2% discount if you pay within those days. But you can still pay up to the 30th day. So under these terms, actually, the true price of the chip is 98, not 100 because the 2 pesos is actually the finance charge, no? So 100 list price has 2 components, the list price of 98 and the finance charge of 2. So again, free trade credit is the trade credit that is obtained without a cost. And it consists of all trade credit that is available without the need to forgo discounts. So costly trade credit, on the other hand, the second type of credit is any trade credit over and above the free trade credit. So for example, in our example a while ago, the costly trade credit is the additional 20 days, okay, from the 11th day to the 30th day onwards, because receiving the additional 39,200, okay, 39,200, how did we get 39,200? Okay, so we will be computing that in a while now. So it is not free because receiving this credit means we forfeit the discount. Okay, so only the first 10 days are free credit. Okay, going back to my example, if the company decides to take the discount, it will pay at the end of day 10. And this would show 19,600 balance in accounts payable, right? So that's 10 days times 20 days, 20 chips per day multiplied by 98 per chip. So we get 19,600. But if the company decides to delay the payment until the 30th day to make use of the cash for the other operations or to finance the other working capital elements, its trade credit will now be 58,800. So if there's no discount, that's 20 chips per day multiplied by 98 pesos per chip times 30 days, we get 58,800. So meaning to say, if we do not take the discount, the company can have additional 39,200 of trade credit. So that's 58,800 minus 19,600. So this 39,200 is a costly credit because the firm must forgo the discount in order to receive this. Okay, so therefore the company must answer the question. Can we actually obtain, can we get this 39,200 at a lower cost from some other source, like from a bank, for instance? So can we get this 39,200 from another source? Because if you can get it, then we should get the discount. Okay, so we should take advantage of the 2% discount. But that's the question that the company should answer. So again, no, to clarify the situation, so um, assuming that the company operates 365 days per year, and that again that it buys 20 chips per day at a true price of 98 per chip. So therefore, our total chip purchases are 20 times 98 times 365. So our total chip purchases for the annual is 715,400. If we do not take the discount, meaning we will let go of the discount and pay at the 30th day, our chip would cost 20 times 100. So on 100, no discount. So 20 times 100 times 365. So we get 730,000. So there's an additional of 14,600. So that 14,600 is actually the annual cost. This is our annual cost if we want um, to avail of the 39,200 of extra credit from day 11th to the day 30th. So if we divide 14,600 by 39,200 additional credit, it will give us a nominal annual cost for the annual trade credit of 37.24%. So the cost of our additional credit is 37.24%. Okay, so again, that's simply dividing our 14,600 difference with or without discount divided by the additional credit 39,200, so we get 37.24%. So if the company can borrow from the bank or other source lesser than 37.24%, then it should take only it should take the discount, no, and should use only 19,600 of trade credit. Okay, so meaning to say, if we can avail from a bank lower than 37.24%, meaning to say we can get at a credit of 18% or 15%, if we don't have additional or cash during the 10th day, then we better apply for a loan at a bank offering 10% or 18% as long as it is lower than 37.24%, so that we can pay the credit at the 10th day. Okay, so another formula for getting the nominal cost of trade credit is discount percent divided by the non-discount net of discount times 365 divided by the non-discount period. So we have here our discount percent of 2% divided by the net of discount, 98%. So 2 divided by 98 times 365 divided by the non-discount period of 20. 20, the risk credit outstanding 30 days minus the discount period of 10. So we have 20. So 2 divided by 98 is equal to 2.04%, and 365 divided by 20 is 18.25 times. So 2.04 times 18.25 is equal to 37.24%. So again, if we can borrow at a cheaper cost than 37.24, then instead of waiting up to the 30th day to pay the credit, we should borrow funds if necessary just to pay on the discount period at the 10th day. So this is how we make use of this kind of information. Okay, so our nominal cost or formula does not consider compounding. So of course, if we want to consider compounding, then we should get the effective annual rate. So of course, we know that if we convert the nominal to effective annual interest rate, our cost of trade credit will be even higher. Okay, so our discount for our discount is equivalent to interest. So yung terms natin 2, 10, and 30, the firm or the company gains use of the funds for 20 days. So there's yun na nga 18.25 times interest periods per year. So our first term, the discount percent divided by the net of discount, yung 2 divided by 98%, yung 2.04%, this is actually a periodic interest rate. So, this represents the funds made available by not taking the discount. No? So, the 2.04%, this is the cost per period for the trade credit. Okay? So, our the number of times that we take advantage of that 18.25 times, that is actually the interest periods. Okay, so that rate is paid 18.25 times each year. So if we get the effective annual rate or the EAR, we know by the formula we have 1 plus I raised to n minus 1. This is the important formula here. So 1 plus I raised to n minus 1. Okay, so that is our effective annual rate. So you have 1.0204 raised to 18.25 interest periods minus 1. So we get 44.59% or 44.6%. Okay. A self-check question. So this is self-check question number 1. So this is now time for self-check question number 2. Okay, so we have here the second type, the bank loan. Okay, so another source of short-term financing of our current liability is the bank loan. No, so we know for a bank loan, we need to apply or to issue a promissory note to a bank. No, and that promissory note would contain the amount that we want to loan, the maturity, the interest rate, the term, whether it is interest rate only, after we pay at the maturity date, then we pay the interest on lump sum, or is it amortized? We every month or every period we'll be paying the principal plus the interest. The frequency of interest payments. How often do we make interest payments? Is it monthly, quarterly, or semi-annually, or annually? The discount interest, the add-on loans, the collateral, restrictive covenants, and loan guarantees. Okay, so line of credit, we have here a line of credit. What is meant by line of credit? So line of credit actually is an agreement between the bank and a borrower, indicating the maximum amount of credit that the bank will extend to the borrower. So for example, we will apply to a bank. Then the bank loan officer would tell us that, well, your company is good for 80,000 for the next year. So as long as your financial condition will not deteriorate. So in that sense, let's say our company would sign a promissory note for 15,000 for the next 90 days. So this would mean that we are taking down 15,000 of the credit line. So 15,000, that 15,000 will be credited to our checking account in the bank, and before it will be repaid, the firm can still borrow additional 65,000, okay, for a total of 80,000. So since 80,000 yung line of credit natin, we can borrow up to the maximum 80,000. Okay, so even if let's say 10,000 first, then may remaining pa na 70,000, so you apply again, take down again the another 20,000. Okay, so this line of credit is informal, and of course this is non-binding. So we have another variation of line of credit. We have what we call the revolving credit agreement, or this is also called as the revolving line of credit agreement. So here, this is a financing agreement. So this is more formal between a lending institution and a borrower. So in these kinds of agreement, the borrower is approved for a certain amount of funds that they can use at their discretion as long as regular payments are made towards the line of credit. So a revolving loan facility provides the borrower the ability to draw down or withdraw, repay, and withdraw again. So it is a revolving cycle, no? That a revolver is what we call the borrower, no? Can apply in the bank. So withdraw, repay, withdraw again. So our revolving loan is considered flexible financing tool because of its repayment and reborrowing accommodation. Okay, so this revolving loan allows the business to borrow money as needed for funding working capital needs and continuing operations such as meeting payroll and payables. So if you may wonder, ma'am, the same lang. Okay, yes, the same. This is similar to an informal line of credit, but there's an important difference here. The bank has the legal obligation to honor a revolving credit agreement. So it cannot refuse because you have an agreement. Okay? So the bank cannot say, no, it is recession now and the economy is not looking good, so we cannot lend money. No, so it cannot say that. No, the bank really need to honor the revolving credit agreement. And also, there's a commitment fee. Of course, the bank, what's the benefit to the bank? Okay, so since the bank is obligated to lend you money, the business in return will pay commitment fee. Okay, so you will be paying, no? So whether or not you will take advantage of the revolving credit agreement, you still pay the commitment fee. Okay, so it's fixed cost. Okay. So we have here the cost of bank loans. Okay, so of course, as what we know in borrowing, interest rates are higher for riskier borrowers. And it is also higher for smaller loans, no? So, if the company can qualify as prime credit, now it can borrow at a prime rate. Prime rate is the lowest, the rate that the banks charge, okay? So, but loans to large and strong customers are made at rates tied to LIBOR. LIBOR, this is the rate, the interbank rate, no, for loans. Okay, so we have here the ways to compute for the regular or simple interest. Okay, so the effective interest rate on a bank loan, we know already how to compute this one. our effective rate will be the more frequent interest is paid, the higher the effective rate. So that's why if as you can see, there are many businesses offering daily, weekly, monthly, okay, bi-monthly. Of course, the more frequent interest is paid, the higher is the effective rate. So if interest is paid once a year, the nominal rate will also be the effective rate. Okay, so if it is paid monthly, okay, so it will be 1 plus I divided by 12. Now, effectively, raised to 12 minus 1. Okay, so that's how you compute, right? Okay, so we also have here add-on loans, add-on interest. So we'll discuss that a while. Okay, so let's have an example here of add-on interest. Okay, so let's have an example, no? Suppose you will borrow 10,000 on an add-on basis. Usually at the department store, you get add-on interest, no? Add-on, okay? Add-on in cars or in gadgets, no? What does it mean? Okay, so if we borrow 10,000 on add-on basis, nominal rate of 0.35% in buying a car with a loan to be repaid in 12 monthly installments. So meaning at a 6.35% add-on rate, you would make total interest payments of 10,000 times 6.35 or 635 pesos. So however, because the loan is paid off on monthly installment, it is monthly installment, you would have the use of the full 10,000 for only the first month. Then the outstanding balance would decline until during the last month, only 1/12 of the original loan is still outstanding. So therefore, you would be paying 635 for the use of only about half of the loan's face amount, as the average usable funds would only be about 5,000. So therefore, we can calculate the approximate annual rate as 12.7%. Okay, so how did we get that? Okay, so going back on the problem, we have interest paid 635. So how do we get the approximate annual rate for add-on loans? So that would be interest paid divided by amount received divided by 2. Okay, so we have 635, our interest paid. Then the amount received, 10,000 divided by 2. Okay, so we have 12.7%. So if you want to get the APR or the annual percentage rate and later on the effective rate for this add-on loan, we can use our financial calculator, no, in finding the payment per month. Okay, so we have 10,635 divided by 12, so we have 886.25. So our N is 12 months. Our PV, it would be 10,000. Payment 886.25. Then future value FV 0. So we can get the interest per year, and that is 0.960108%. So this is still a monthly rate, so we need to multiply by 12. Then we get 11.52%. So this 11.52%, this is the APR that the bank would report to the borrower. Okay, so the APR. So to get the effective annual rate for that, so 1 plus I raised to n minus 1. So that's the very basic formula for effective annual interest rate, no? So 1 plus I, 1 plus 0.09009601108 raised to 12 minus 1. So we get 12.15%. So our annual percentage rate, APR, would be 11.52%, then the true effective annual rate would be 12.15%. So therefore, both of these are actually higher than the nominal rate of 6.35% add-on loan. Okay, so we have here a third source for our current liability. We have the commercial paper. So commercial paper, these are unsecured short-term promissory notes of large firms, no, that are usually issued in denominations of 100,000 or more with an interest rate somewhat below the prime rate. So we have here number 4. We have accruals. So these are accrued liabilities. So accruals arise automatically from the firm's operation. So therefore, these are spontaneous funds. No, spontaneous funds. So sample, if our sales would grow by 50%, accrued wages and taxes should also grow by 15%. So actually, accruals are free. In the sense that there's no interest that is being paid on them, but firms cannot control their accruals because the timing of wage payments is set by the contract or industry custom, ano yung norms and tax payments. So firms actually use the accruals, no? As long as they can withhold salaries, okay? So just to fund, no, their working capital. So actually that is based on which angle you see, no, for the workers, it is quite a disadvantage because that salary, that money is due to your efforts already, but the company is withholding that salary because it will still use the salary that should be paid to workers. It will still use to finance the working capital, no, for operating cash, inventory, receivable, and yun. So we have here our fifth source, security, using security in short-term financing. Okay, so the most common securities here that are used are inventories and receivable. Okay, so we have an example here. Okay, considering the case of a hardware dealer wanted to modernize and expand the store, so requesting 200,000 loan. So the bank would offer 100,000 unsecured basis. The interest would be 10%. Okay, so the bank would offer 100,000 loan, unsecured basis 10%. But if the company has 300,000 accounts receivable that can be used for collateral, the bank can give the 200,000 full loan because what is being applied actually is 200,000 and a prime rate of 3.25% as long as there's a collateral of 300,000 accounts receivable. So that's why we have in financial accounting, we have assignment or factoring of our accounts receivable. So those kinds of, those are the ways of short-term financing. Okay, so time for self-check question number 3. Okay, so class, that ends our lecture for today. So let's, next lesson coming up would be capital budgeting on lesson 1, conceptual overview.